Welcome to Mark Arnold's Finance. So we had a positive jobs report, but yet the market went down. So what gives? Well, I'm going to explain why that positive jobs report created a negative day in the stock market. Before I get started, be sure to subscribe to my channel. I'm somebody that's very transparent. I'm working hard to always provide you guys with good quality content, and I always welcome your opinions and to guide me on what kind of topics you want to hear about. So let's get started. As promised, I'm transparent, so I'm going to show my portfolio performance with every single video. Now, we will see here that I'm barely in the green. I've been flirting with going into the red to the green by a few percentage points, but I'm officially, again, in the green by just $100. I'll take it. Amazon, again, went up pretty decently from it being in the red. So I think because I have a lot of money in Amazon, that's kind of making me kind of fluctuate more heavily. Meta I think it's been staying around that 160, 170 range. So until that pops and goes up, that's going to be a big drag on my portfolio as well. But take a look at this. Feel free to pause the video. And if you want me to add any extra, information to this, let me know. I'd be happy to do so. But I want to make it quick and easy for every video so it can be quickly read, and you guys can ask me any questions about my portfolio down in the comments. I also want to mention that I received my VICI dividend, and it came out to $25.92, so almost $26. And what I want to mention is that's the power of dividend growth investing. You put your money in a company, you don't do a thing, and you get rewarded monthly, quarterly, biannually, whenever they do pay out. So I'm going to put that money right back into the stock market. I reinvest all my dividends and just keep my portfolio growing. And hopefully someday that percentage that you saw of me being slightly in the green by just $100 or 0.25% will someday be massively in the green, and I'll be making a lot of profit. So be sure to subscribe again to follow my journey, and let's see how I do. I am planning some big changes to my stock portfolio, but of course, I'm waiting for the right moments to do that. So also be sure to follow me because there will be some changes when I feel the time is right, because there's some stocks in there that I am eyeing to do some things with. So let's get started with the jobs report. Let's start with the good, the data. So the unemployment rate held at 3.6%, remaining at a 50-year low. So that's great news. The hourly earnings rose 0.3% from the month earlier. So it's still showing that, those wages are increasing month over month, though I know they're far from what inflation is, but they are increasing. There was 372,000 jobs added versus the expected 270,000 jobs. And so that's a 100,000 job difference from what they expected to what actually happened. So that was a big positive thing. And then job openings and quits remain near record highs and layoffs near record lows. So it's still a very competitive job market. There's a lot of jobs out there, and I still think it's a great time to find work unless you're in the tech or the housing sector. Those are the ones that are struggling. And I found this snip from this jobs report that is showing also if you have less than a high school diploma or you're between the ages of 20 to 24, it's going to be a little bit harder to find work because those unemployment rates are higher than the total unemployment rate that was just released at the 3.6%. So something to keep in mind. Get those educations, be persistent, don't give up, and you will find a great job. And right now, before we possibly head into some rough waters, what I'm expecting, it's probably a good time to get a job. So now the bad. This is what I think is the bad from this report. I think a recession is still a real possibility, but because of this positive news, it just might be delayed a little bit, and I'll explain more on that in a minute. Inflation remains near a 40-year high. This is just going to be a drag on the economy and the stock market until that gets controlled. Layoffs are happening, like I mentioned, in the tech and the housing sector, but I think it could spill into other sectors should we see these inflation rates stay high and companies' expenses keeps going up. And if that recession hits, we could see the layoffs expand outside of those two sectors, the tech and housing. So again, I think now's the time to start, getting that job you want, because we could be in for a rough end of the year next year, possibly if, things get worse. Also, it was reported that people are dipping into their savings accounts. We had a lot of stimulus over the last 2.5 years, and now that that's kind of dried up, people are now moving into their savings account to pull out, which to me signals that inflation is increasingly biting into households' budgets. And all that means to me is that's going to be people spending less money out there in the economy. So it did show that the shopping spend is down, but yet the vacation spend is up. And I will tell you, I am going on a vacation in a few months, and I know plenty of people around me that are doing big vacations. And I think that's just pent up demand. We had over 2 years of people not really being able to travel. And now that the pandemic is a very much less of a concern, people are getting out there. So I do think that we will see a massive slowdown of all spending after this kind of summer vacation period when, we might have that recession hit, possibly inflation still, eating at everyone's budgets. And with people dipping into their savings, there might be a point where they don't have much money eventually because they've exhausted it all. And that could put a huge slowdown on the economy as well. So why was that positive jobs report? Why did it create the negative effect in the stock market when it got released? Like I used to say when I was young, what the double H hockey sticks is going on, right? You have positive news on the economy, but the stock market went down. Well, I'll tell you why. The stock market is always forward looking. And with a positive jobs report, that means that the economy is still hot. It's still doing fairly well. Yeah, there are some areas that are starting to kind of get weakened, but overall the economy is still doing well. It's still healthy, which means that the Fed trying to control inflation and cool off the economy isn't really working yet. And what that means is that the stock market is expecting another massive rate hike now in July. I think it's in a week or two, where it could be another record 75 basis points. And what that means is it's just going to make it more expensive for companies to borrow money, and the future spending will slow down of consumers, which will hit their bottom lines. And we could see some, negative earnings results in the next couple quarters and throughout next year. So that's why the economy is reacting negatively. They do want to see the economy cooling off. And Jerome Powell himself, he wants to see job openings and wage growth slow down, because to him that signals that the rate hikes he's doing is cooling off the economy, which is what he wants, because he wants to tame that inflation. And so far it's showing that it's really not doing the job that it's supposed to do. And so until we see that economy cooling, I think they're going to continue to be aggressive with their rate hikes, with their balance sheet reductions. And, this could lead to an recession. Just it'll be delayed a little bit because the economy still is pretty healthy. So we could see the recession, what I predicted in a prior video, hit the end of this year or sometime next year if it hits. And we don't know if it's going to be a light recession or a pretty drastic one that lasts for a long time. But on average, recessions last about 11 months. So who knows if it'll be less than 11 months, more than 11 months if it hits. So I just think this is delaying the recession. And so the market is forward thinking. So they see, the Fed's going to be more aggressive. That could signal that the Fed wouldn't be able to do that soft landing that they talked about. And it could just create that drastic, hit to the economy, and a recession hits. It could be a bad recession. We could see stock market crash. I believe we've kind of already seen that so far this year. If you kind of go from January till now, there's a lot of companies that are down 50+%. And so, what should we do? What should we do to prepare for this? Well, we should keep investing. We shouldn't let fear take over. We shouldn't see this as, I need to stop what I'm doing and, hoard my money into a savings account. Always have that rainy day fund. But I think you keep buying these quality companies at great valuations. That's what's happening right now. And long term, that's where people become wealthy, is when they take advantage of those times that other people are fearful. Because to me, it doesn't make sense, right? Last year, you were buying companies at high valuations, but now that they're lowered, you're not doing it. Doesn't make sense to me. So keep buying. Buy those companies. Whether we have another 2 years of these companies having lowered expectations, which means their stocks go down, lowered earnings per share, eventually, if they're a quality company, they're going to turn around. You look at Microsoft, for example. Yes, right now their PE ratio is higher than the broad market, but this is a high quality company that I can pretty much guarantee will be around longer than you and I watching this video, which means it's a quality company. You look at its financials and fundamentals, which I can go into, but that will take this video to twice as long. But you can just trust me and go look for yourself. It's a high quality company, and this might be the time to buy a company like that at much lower valuation than it was a year ago, because I think without a doubt that will turn around, and that's going to be for many of those quality companies out there. So focus on buying quality, focus on looking at their valuation, see how much they've come down from a year or two ago, and look at the long term. Will this company be around in the next 20 to 50 years? If that answer is a solid yes for you, it's probably worth investing in. And so like I said, right now are the times where people make money in the long term. So don't be fearful. Don't turn your back to this stock market and let the headlines grip you and stop you from investing at a time where I think it's a rare opportunity to be putting your money in the stock market for long-term amazing returns. So let me know what you think of this job market, this healthy job market still, creating a negative stock market reaction. And if you agree with what I put forth, why it's going down, possible recession happening next year, and what you plan on doing with your investments. Like I said, I'm going to keep buying on my regular every 2 weeks when I get my paycheck, and if I have any extra money, I will be putting it into the stock market without tapping into my savings. Don't tap into your savings. Try your hardest unless if it's an absolute emergency, but any extra funds outside of that savings that you've saved up, if you're able to put it and invest it, I think now is a great time. So let me know what companies you are investing in now that their valuations are lowered, and or what companies you plan on adding to your portfolio. I'm eyeing a few companies. I'll just give you one. I'm eyeing Ally Financial. I've always looked at this company for the past couple years, but there's always just that one thing that keeps me from getting in. So maybe I'll do a video on that soon. Let me know if you want to see a video on Ally Financial. And let me know what other companies you guys have on your watch list that maybe I should be looking at. Maybe I can do a video on them, do some comparisons. The sky's the limit on this channel, so just let me know. And I hope you guys have a great day, and we'll see you next time on Mark Arnold's Finance.